What's up guys? So in this video, I'm working on a one-on-one with one of my students who actually came in asking some really beginner questions. In this video, I talk about what an inverse fair value gap is, how to spot fair value gaps, and what break-even actually means. But obviously, I talk way more about what the strategy in my system actually entails and how to spot things correctly and what my thought process is through it all. So if you guys have been stuck in the same spot, overcomplicating smart money concepts, or just not understanding what direction you want your training to go into, well, this is the right video just for you. So without further ado, let's get started. So first off, I want to be looking for where liquidity is lying, okay? So I want to be going into the 1 hour chart and seeing if we have any sweeps or not. So here we don't have a sweep, right? So like, where's liquidity lying? It's lying, you see these points right here?
Yeah,
All of these points, these highs, these lows, highs, highs, highs. All of these points, there's stop losses lying here. So people put their stop losses at these levels. So when market goes up and then reverses, that's telling us that market definitely wants to hit this next like liquidity level, you know? So that's
yeah,
how we kind of base off where we think market's gonna go, just based off liquidity and reactions. So like let's just say we do
yeah,
sweep liquidity, but we don't get a strong reaction. That's telling us maybe market doesn't want to go there, you know? Maybe market doesn't want to come all the way up
yeah,
here. But if we sweep a liquidity and we get a really strong reaction to the upside, that's telling me that market definitely wants to hit this next liquidity point. Does that make sense?
yeah.
So that's essentially just how we're going to be looking for it in the higher time frame. So by higher time frame, it's just the 15 minute, the 1 hour, the 4 hour, like anything above the 15 minute is I consider the higher time frame. Anything
Okay,
below the 15 minute is lower time frame. So that's just going to be
okay.
below framework. Going back to the 1 hour, what I want markets to do right now is sweep some sort of liquidity. So I want market to kind of come down, maybe sweep something to go to the upside. Okay, so let's see what happens. All right, we took it out. Okay, so this reaction is probably telling me that we're not gonna like go back up, right? So now what
Yeah,
I'm gonna do is just kind of adapt and maybe wait for this sweep of liquidity. Okay, so
okay.
let's see what happens. I'm just gonna mark it out to make it easier. Okay, we took it out. Now let's see if we get the reaction to the upside or not. Okay, looks like we closed above, creating an SFP. So it looks like it failed to close below. So this is a good reaction to the upside. So now I want to go into the lower time frame and look for a potential entry point based off the reaction, and it looks like we do have one right here to the upside. However, um, we do have, let me see, 30-second. Yeah, this trade would technically be invalid because we did sweep liquidity, like our intraday liquidity, which is like our break-even level. So I want to show you something. Let's just say that the candle closed above this inverse fair value gap. Do you know what an inverse fair value gap is or no?
Inverse for value gap.
An inverse fair
Um,
value gap.
I think it's like what, three candlesticks like by each other where they're like aligned, probably the same pattern. I don't really understand it like that,
Okay,
but
it's okay.
kind
So
of.
if you don't understand something, just let me know so that I can explain it to you. Like it's okay, but I'm here to teach you. I'm here to make sure that you do understand. So don't be like embarrassed or afraid to tell me that you don't know something, okay?
Okay.
All right, so here we have a fair value gap. So it's essentially just you see how these three candles, it's just three candles. So it's one, two, three candles. But notice
Yeah,
how in the candle in the middle, we left this gap. So there's like this wick is not down here and this wick is not going up here. So
yeah.
since there's no wick, this is what we call a gap, a fair value gap. Okay.
Okay,
So like a fair value gap is essentially the market going too fast one direction, kind of leaving this gap. So it's like an imbalance in the market. Does that make sense? So
yeah.
just think about the market, like when it comes to fair value gaps, think about the market going down too fast, creating that imbalance in the market, kind of wanting, I guess, the buyers or the sellers to eventually come back to this level and use this as liquidity. Okay.
Okay,
So market came too fast down here. Like market came down too fast, creating this imbalance in the market, and this is called the fair value gap. However, the way we enter the market is we wait until this fair value gap gets closed above to enter the trade. Okay?
okay,
So there's a fair value gap right here. So we want market to kind of close above this fair value gap, creating the inversed fair value gap. And then that's how we would enter the market. And then usually when we do inverse the fair value gap, We tend to go the opposite direction or the direction where the fair value gap got inversed. We tend to. So that's why we enter inverse fair value gaps and they're powerful.
Okay.
So I want you to watch something. We're most likely going to pump up here just because we closed above the inverse fair value gap, but I personally wouldn't enter this trade. So like we enter off the close above, right? I personally would not enter this trade because we already swept a liquidity zone. So I had marked it right here, right? So like I'm just gonna
Yeah.
mark it like a V shape right here. So notice how this is a liquidity zone, right? And market kind of went above it and it might seem like we're going down. So this is telling me that like if I was in this trade, I would go break even. So like I would put my stop loss to my entry point because this is a potential rejection zone and I don't want to be in a trade where it's more likely to reject and just stop me out and I lose, okay? I want to be taking the best
Yeah.
possible trades. So that's why I wouldn't take this trade. However, if the candle closed like right here, I would instantly take this trade. And the second that the market hits this level, which is like the next, like I guess potential reversal zone, I would move my stop loss to my break even and I would just hold it to the top. And for example, if it hits my break even, well, then I'm out of the trade. But if it doesn't, then I'm in the trade and it's risk free to go to my CP, take profit.
Okay.
So that's usually how it works. So I'm thinking it's probably going to go up, but just for risk management purposes, we're not going to enter this trade because of this liquidity zone, the fact that it hit it at the same time that it closed above. So the trade is invalid for me. But I do think based off higher time frame liquidity that the market will pump up. Let's see what happens. Okay. Looks like it did not pump up, and that's really important. Like I'm glad it didn't pump up because look, it hit this level, right? And I literally told you that if it was going to hit this level, there's a potential um option that we're going to reverse. So that's why like we
Yeah.
wouldn't have entered the trade because I expected the market to go up. However, this level right here is telling me that we could potentially go down and reverse everything. So I don't want to be in the trade. That's why I told you I'm not going to take the trade just because of risk management. So if we entered the trade, we would have lost. Do you have any questions about anything before we move on to the next example?
So you guys trade by like inverse for value gap. Y'all don't do like by break of structure.
No, no.
Okay.
Because in my opinion, break a structure, like yeah, I mean technically, bro, we did break structure right here, and look what happened.
Yeah, you did. You got. Yeah, you
Yeah, I
did.
got
And then it
cooked.
just broke structure and it went down.
Yeah, so like I don't know, bro. I mean, I do use break a structure for like confluences sometimes, but like when it comes to entries, in my opinion, you don't need it because the inverse for value gap, in and of itself, the essence of the inverse for value gap should end up hitting this next liquidity point, which it did, like it did. So that's what matters to me the
Yeah.
most. The fact that like this is so powerful, the fact that it hits this next liquidity point, so I don't have to really worry about waiting for a break structure reversal tapping. Like nah. Also, I feel like you miss a lot of trades by waiting for that. And like I
Yeah.
usually take a trade a day, so I mean I don't really
I'm kind
miss
of
trade.
glad it went. Yeah, I'm kind of glad it went down also because knowing me, like, it's all about patience. Like in trading, just being patient, waiting for the right time on the right moment to
Exactly.
take a trade and profit. Um, like with the knowledge that I know now, I would have probably because you can see the breaker structure on the downside also.
Hmm.
Seeing like where the the 9 frame right there, yeah. Uh, I would have probably even if you being patient, based on seeing all those blue candles going up, I know market was going to end up shifting regardless.
Yeah.
Probably doing another liquidity sweep. Am I right?
Yeah, honestly. So like usually when these things fail, there's usually a better setup that happens. So let's see if we actually get that other sweep. So I want to go into a higher time frame. Maybe look for why market's dumping right now, and it's probably because we want to hit this low. Let's see if it's like a important low. So like I usually check if the liquidity has like if it's a London low, which is like from 2 a.m. to 4 a.m. or an Asian low or like just something. This is a PM session low, so I mean it's not really much, but um it's still an important liquidity because like it's like obvious, you know? It's just an obvious
Yeah,
liquidity. So it's still an important one. And I do think market will probably sweep it to go to the upside. But actually, something I always look for is a 12 hour. So let me just add a custom. So the 12-hour chart is actually the most important, like one of the most important charts in my opinion. Because well, usually once we get a sweep on the 12-hour, we like 80%, 90% reverse, bro. Like actually, it's crazy. Like here, look, sweep, reverse, sweep. Technically, we went up. Where else? Like it's usually like very like it's very prominent. Like sweep right here, we reversed. Or else sweep right here, reversed. Like this is kind of like how you kind of know where market wants to go. Sweep right here, reversed. Um, Sweep right here, reversed. Like you see the pattern? So usually on the 12-hour
Yeah,
chart, we see a sweep and then it reverses. So like I do like to see the 12-hour chart a lot. So that's why I'm saying like if we do take this out, we'll probably go back up. But like I said, we're not trying to predict the market. We're trying to react off of it. Okay, that's like my motto.
yeah,
We don't want to predict it. We just want to react. So let's see what happens. My intraday sweep is just like a sweep that happens recently. Okay, it looks like we're getting upside momentum for some reason. Don't really see why, so I'm just gonna wait. Okay, maybe the 5 minute? Because they're looking what's the setup. But no, yeah, this I think it's gonna come back down anyway.
yeah. I thought it was also. But I was just gonna go exactly. See,
Yeah, we have to wait. Okay, it's gonna sweep this to go to the downside. Let's see what happens though. That's just what I'm thinking though. I know it's 12 p.m., so they're at lunchtime. We low-key have SMTs up here, bro. So there was like a setup up here probably. Yeah, like right here. No, but that's too small of a gap. So the reason why I wouldn't take this is because this fair value gap is so tiny. So like I don't want to be taking like small fair value gaps. Even though it worked out, I still don't want to be taking these small fair value gaps because like overall they would probably screw you over, you know? But yeah, like
yeah,
this is like a little teaser of how like our strategy works. So like if this fair value gap was like way bigger, this would have been a perfect trade. Like notice how it just went straight down, bro. Like this is how I like to be trading. I don't like to be like trading when the market's kind of like going like bouncing around. Like I just want market to go straight to my take profit, and that's why I like the strategy. By the way, this is not a trade that I would have taken just because the gap was so small. And I'm looking for a sweep first before taking anything. So let's see what happens. Looking for a sweep, maybe 15-minute, anywhere. Okay, we took this out. Okay, that's important. So now I want to go into a lower time frame after taking out higher time frame liquidity. I want to be looking for something. Okay, we do have a gap right here. So how do we know that this is a fair value gap? Because there's no wick. So it's just the three candles. Focus on the three candles. There's no wick here, and there's no wick here, right? But if there was,
yeah.
this would literally be nothing. But since there's no wick, we created this gap in the market, and I'm just marking it out. Okay. So like usually, what I'm thinking in my head right now. Wait a minute, we look already set up on the 3 minute. Yeah. So here we actually do have a gap on the 3 minute. And it's important that we do look at all the time frames. Why? Because notice how in the 1 minute there's nothing here, but on the 3 minute
Yeah,
there's a gap. Do you see this?
yeah.
So we could actually enter off the 3 minute here. We put our stop loss below the gap, and then we would just target like a higher time or like just like some form of like the next form of liquidity. Okay.
So the higher the time frame, it shows like where is that before the lower time frame. So
Um.
say if I was to go to like an hour time frame and the market is going down, but on the 1 minute time frame, it's showing the market is going up. So basically, in the future, it's going to go down on the 1 minute. Am I right or am I wrong?
Yeah, you're right. So like the market just moves based off the higher time frame. That's usually,
Okay.
that's how we get our bias. So the market moves based off the higher time frame. The lower time frame is just like minuscule moves. It's nothing crazy. And like I don't want to be taking shorter time frame longs when our bias overall based off the higher time frame is short, or like bearish.
Yeah.
It's just not smart in my opinion. So let's see
So
what
you.
happens. Wait, go for it.
So which time frame do you think is best to take a trade on?
Okay, so anything below the 5 minute time frame, like even the 30 second, I would take a trade. Like the main ones are these four, the 3 minute, 2 minute, the 1 minute, and 30 second. Those are the only time frames where I usually take a trade. So like I
Okay.
usually just switch between those like a lot. So I like for example, if I think something might set up or like I'm looking for a trade entry, I look at the 2 minute, I look at the 1 minute, and I look at the 30 second. And in my head I'm thinking like which one's the one that looks the best? So in this case it's the 3 minute because it's obvious. It's just a singular
Yeah.
gap. The market just
Yeah.
went
Single
straight
gap.
up, created a perfect V
Yep.
shape. Okay, so those are the trades I want to be taking. So honestly, I think this would be a good loss to take. So if this trade loses, I would be happy just because like it would be a good loss, you know, like you want to be taking the trades that are uh, are like just part of our system. Like we just want to stick to our system.
Yeah.
So like in this situation, I would enter the trade. I would put my break even right here. Why? Because it's the next liquidity point. So the next liquidity point is most likely to reverse. Or like there's two things that could happen once we hit this level. Market's gonna use this to go even higher, or it's gonna use this to come all the way back down and just reverse, okay? So I obviously want it to go higher, but just the fact that it can potentially reverse and like this is just the target.
You want to
Um,
wait. So you want to wait until see what market does first, then
no, no,
take the
no, no,
trade,
no.
right?
I'm not gonna wait. I'm not gonna wait. I'm gonna enter the market just strictly based off liquidity and the inverse value gap that's set up. But the second that market
Okay.
hits this, I'm gonna be moving my stop loss to my break even to make this a risk-free trade. Does that make sense?
Yeah. Okay.
So
So
like
you
yeah,
won't
I'm
probably
still in the
lose any.
market. Yes, just I'm still in the market. Don't get me wrong. So like if the market goes straight up, I still make money, but it's a risk-free trade. And I expect the market to go up a lot more once we hit this liquidity point. I don't expect it to come down. However, the chances that we do come down are higher than going up once we hit this. So that's what I'm saying. I want to be risk-free. So let's see what happens. Okay, projecting a little bit. Okay, so here I would actually move break even because we did hit this. So I want to be moving my, I guess, what is it called? Internal high. So like when there's like our break even, you know what break even means or no?
No.
Okay, so break even just means we move our stop loss to our entry point. That's what break even means. So
Okay.
break even means we're just moving our stop loss to our entry point to make the trade a risk-free trade. Okay?
Yeah.
So if market does come back to our entry point, we get out of the trade and we don't lose any money. Okay? So that's just
Okay.
what it means when we go break even. We basically don't win money, but we don't lose money. And it's important for us to go break even, especially when we think market is likely to reverse in these levels. So here I would move my break even. I would move it to break even because we formed a new liquidity and we swept the new liquidity. So this is called like internal liquidity. Okay.
Okay. Yeah.
So this is essentially how we move our stop loss to break even. Let's see what happens. See? Notice how it used this little liquidity point to go even higher and it didn't come back to our break even. So at this point, I would probably take out 25% of our position and I would hold the rest probably to the very top. So let's see what happens. So at this point, we made money on the day already and we already are risk free. Okay? So like
Okay.
we're in the best position we possibly can be right now. So like even if market goes all the way, even if market stops us out, it doesn't matter, bro. We already made money. We're already on a green day. And we're not going to take any more trades on the day, okay? Let's see what happens.
Yeah.
Okay,
Is that
it
a
just stopped us out,
okay?
which is fine. That's
All right.
perfect.
Good job.
At least we made money. That's all that matters. And we made money not risking, like, it was risk free. So notice how it swept this level and then just instantly reversed. So that's why it's important that we do go break even because we don't want to get cooked. Does that make sense or no?
Yeah.
Alright. So that's essentially the strategy, bro. Do you have any questions about anything?
No, you pretty much covered it. Like it made total sense. It's a great strategy. I never thought of this strategy at all.
Yeah.
It's, like you said, there's multiple strategies. Like everybody, every day, other day trader, they do their own type strategy. Um, like breakup structure. That's why I asked you if you probably do breakup structure or you check on like candlesticks in general. It always tells a story, but it's more based on like what strategy you're using. Because even though candlesticks can tell you the story, you can't just use a candlestick pattern strategy on basically what you see in the market because it's basically what the markets want to do.
Yeah, exactly. But look, I look, like this trade if it sets up. Oh, yeah, look. So we swept the higher time frame. Honestly, bro, the reason that that trade probably went break even is because we actually want to sweep this low. And look what happens when we swept it. We got a wiki candle, you know?
Yeah.
So now I want to go into the lower time frame. I want to wait for a perfect reaction to the upside, which is looks like we're getting here. I want to wait for a good reaction to the upside, and I want to look for a singular and obvious fair value gap. And we instantly have that right there. So now I'm just waiting for market to close above this fair value gap or this inverse fair value gap so that we can enter the market. So let's say one, two. All right, so we just closed above right here. Now I'm going to put my stop loss below And I'm going to be targeting some liquidity, okay? So that would be our first target right here. And honestly, our final target would probably be this for like almost 2 hours. So let's see what happens. Let's see what the journal. So where would our break even be here? I would actually want you to tell me, where would our break even be here? Break even be here.
Our break in.
Our break even, where would our break even be?
I'll say like at the no, not that one.
Oh, this
The
one?
one a little bit lower. Yeah.
Okay. So honestly, bro, I would probably put my break even off this fair value gap, not off liquidity, because since there's no, I guess, obvious liquidity, because this is nothing. Like this is, there's like, since it doesn't, it's not a V shape, it's just going straight down. You see how it's going down like this? There's no V shape
Yeah.
being made. This is nothing. So like, I think market's just gonna run right through this.
Okay, because it was
Especially,
an indecision before.
yeah, it's because it just went straight
Okay.
down. So there's really no liquidity lying here because it just went straight down. However, this is a potential rejection zone, okay? But I won't really put break even off the top. I'd put break even off the close above it because if we close above it, I don't expect market to come back down. Does that make sense? It's like
Yeah.
this is a very rare circumstance where there's literally no liquidity point here where the market just goes straight down. It's a very rare situation, so I would probably put break even off the close above. And this, yeah, so this is nothing, and I would put break even off the close above, and this would be my first take profit. So let's see what happens. Honestly, this is a really good trade. I would take this loss any day of the week. Okay, looks like we're rejecting. Okay, rejected. Okay. Oh my goodness. So here,
Oh,
I would put stop loss break even to make it a risk-free trade. And at this point, I'm just gonna click on the next candle. Okay, at this point, I'll take out like 50% or not, 75% of my profits, save. So at this point, I actually made a bank on the day. And I know for a fact, based off this entire momentum, we're definitely gonna hit this, bro. Just based off everything here, we're definitely gonna hit this high. So I'm just gonna hold my last runner. Just hit it, just like that, bro. Does that make sense?
geez. Yep.
All right. So these are the trades that I want to be taking. I don't want to be taking trades where like, oh, like we have some rejection, but we don't know where actually market's going. Oh, it's a little bit, I don't know what's going on. I want to be taking trades where I know where market's gonna go. Like trades like this, bro. Where it's like you
Yeah.
don't even see any rejection. The only rejection we saw in this play was just this. But all it was doing is reversing, tapping back into here, which is fine. Like it doesn't matter. And we just rode it all the way to the top. Why? Because of the higher time frame. So look at what the higher time frame is telling us. We have a 1 hour sweep, good reaction to the upside. So now we're going to the lower time frame and looking for our entry point. Now it could have been in the 30-second, it could have been in the 1 minute, it could have been the 2 minute, the 3 minute, it doesn't matter. Just the fact that we saw an inverse fair value gap set up, we just enter at the top and we just ride it to the top. And we know this is most likely going to work because of the higher time frame, and that's the best part about this strategy. Does that make sense or no?
Yes, sir.